Are you thinking of buying your first home? If your answer to this question is yes, let me help. My name is Nikki Pike and I'm a mortgage broker with TMG, the Mortgage Group. I've been a broker for almost 14 years and I have helped many first-time homebuyers just like you. So let me help you too. One question I get asked quite often by first-time homebuyers is, how much do I need for a down payment? The answer? Minimum of 5%. So what does that look like? If you're looking to buy a home, and let's say the home is a $300,000 house, you would need, for down payment, you would need a minimum of 5% down to purchase that house. That 5% can come from different sources. So this is where it gets a little interesting. So that money can come from your savings, it can come from an investment, it can come from a gift from an immediate family member, it can even be borrowed if you qualify for a borrowed down payment. Another way that you can come up with the first 5% down is through what is called the First-Time Homebuyers Plan. The First-Time Homebuyers Plan is something that allows you to take money out of an RSP, tax-free, and put that money towards the purchase of a house. There are a couple things you need to know before you take money out of an RSP to make sure you qualify as a first-time homebuyer. So that's the first step. Let's make sure you qualify as a first-time homebuyer. The government does have rules around that. The second step is the RSP needs to be in place for 90 days. So you would need to put the money into that RSP and it has to stay there for 90 days before the money actually qualifies to be withdrawn under the First-Time Homebuyers Plan. Once we've determined you're a first-time homebuyer, we've determined the money has been in there for 90 days, then it's a government form that you sign with the bank or financial institution that holds your RSP. You say, yes, you're a first-time homebuyer, you withdraw the money out. There's no tax implications, no tax withheld at the time of withdrawal, so that's the key piece. Normally to withdraw from an RSP, for any other reason, you would pay tax at the time and potentially tax when you do your taxes. So under the First-Time Homebuyers Plan, you take the RSP out, there's no taxes being withheld or tax implications. Then you have 15 years to repay the money. Now, if you don't repay the money back into an RSP, then you can have tax implications. And when you repay the money, so it goes back into an RSP, what they want is 1/15 of the amount that you took out to be put back into an RSP per year. And then you need to put that on your income tax so the government is aware that you put that money back into an RSP and you're putting that towards your First-Time Homebuyers Plan balance. And then once it's all repaid, it's all repaid. What is a pre-approval? This is a question I get asked a lot, so I'm just going to answer it right now. A pre-approval means that you have taken the time to speak to someone about getting a mortgage, and in my opinion, it means you've taken the extra step to verify the information in your application so that when you go house shopping, you know that the person that's looking at you on paper to qualify you for a mortgage has done an application, they've pulled your credit, and they've confirmed the details in your application. So if we just kind of go back a step, the information we need in an application to complete a pre-approval is pretty basic. We need to know name, birth date, social insurance number, 3-year address history, 3-year employment history, income, and then we pull credit to take a look at your debts. So then we pull all that together, and then I'll come back and I'll say, okay, so I see that this is what you do for work. Now I need to confirm and verify that that's what you do, that's where you work, and that's how much money you make. So usually I will ask for maybe 2 years of T4s, a pay stub, maybe tax returns, notice of assessments. It really does vary on each individual situation, so what I ask for would be very specific to you. From there, we take a look at how all of the pieces of the puzzle pull together. So your credit, your income, your debts, and affordability on purchasing a new home. So the next question I get in regards to a pre-approval is, well, am I guaranteed to get approved? The quick answer to that is no, because an approval is also based on the property you're buying. So a pre-approval approves you, the borrower, it confirms the details in your application, and it supports those details with paperwork. But your final approval is still 100% subject or depending on the property that you're looking to buy. A question I get asked quite often, and a really important part about buying a home, is how much can I afford? So how do we determine what you can afford? What we do is we take a look at how much money you make with your job, whether you're self-employed, whether your salary, whatever your income, wherever that income is coming from. We take a look at how much money do you have coming in every month, and then we compare that to what do you have going out every month. So what do you have for monthly debts, whether it be car payments, a credit card payment, maybe a line of credit. And then we of course have to factor in the new payment on the mortgage. So we look at your income, your current payments, and what are the new payments going to be on the house you're looking to purchase. So in that regard, we look at the mortgage payment, we include what the property taxes will be, and we look at a heat payment. And that is how we determine how much you will afford. What does my credit need to look like to qualify for a mortgage? So the first thing we're kind of looking for is how long have you had credit? So we want to see that you've had credit minimum a year, preferably 2 years. If you've had credit for 2 years, that's going to open up your options as far as lenders. Another thing we're looking for is how many accounts or how many trade lines, how many different things do you have reporting to your credit bureau? So what kind of things are considered an account or a trade? We are looking at a credit card, a vehicle loan, a line of credit. Cell phones also report. So we want to see that you have something that you owe money to or someone you owe money to on a monthly basis, and that you're making those payments on a monthly basis, and that you're making those payments on time. We also want to see that you're managing your credit. What does that mean? Managing your credit means if you have a $2,000 limit on your credit card, you're not constantly at a $2,000 balance. So you're using your card appropriately. You're using it, you're paying it off. You're not carrying a consistently high balance. So those are the main things. We want to see how long you've had credit. We want to see what kind of credit you have. We want to see that you're managing your credit in a good way so the lender or the bank feels confident that you will make your mortgage payment on time.